Hello, and welcome to Arnerich Massena's second quarter MarketCast. Markets have been a little more volatile in the past few months. After a long period of record growth, some investors may have been taken by surprise. Yet, as unsettling as this market volatility may be, it's been our job to be ready for it, and now that it's here, to carefully watch for opportunities. In fact, we think the best opportunities can often occur during these periods of high volatility. With this in mind, in today's MarketCast, Senior Investment Advisor David Janec and I will review the market's recent activity and share our strategy going forward. So I'll turn it over to David to get started.
Thank you, Reegan. Volatility has certainly come back worldwide. Stocks and bonds fell sharply in the second quarter, with U.S. stocks underperforming international and emerging markets. This downturn was driven by a combination of restrictive monetary policy, declining growth expectations, supply chain disruptions, and geopolitical uncertainty. And at quarter end, the Atlanta Fed's GDP model showed that the U.S. economy may have already entered a recession. And the downturn also extended to bonds, which fell 10.3% through June, their worst first-half performance on record. In this chart, we overlay the path of bond returns throughout the year for every calendar year going back to 1976. Bonds tend to be sensitive to monetary policy, and they can be volatile whenever policy changes. For example, in the first quarter of 1980, bonds had a similar Fed-driven sell-off, but quickly recovered when the Fed reversed its policy later that year. Now, looking at stocks, the S&P 500 index fell 20% through June, its worst first-half total return since 1962. And, like bonds, stocks can also be sensitive to economic news. For example, in the first half of 1932, stocks plummeted during a period of severe deflation, but soon recovered on news of stabilizing prices. So, having seen how sensitive stocks and bonds can be to changes in inflation, what's the current outlook for inflation? Here we can see that inflation has been accelerating for more than a year, with U.S. consumer prices rising 8.6% through May. The rise in prices has been broad-based, driven primarily by energy, shelter, food, and services. And while future inflation is unknown, FactSet consensus estimates are now calling for 7.5% inflation for the full year in 2022. Bond market prices have been implying that investors expect annual inflation to drop to 4.3% by next June and to average 2.4% over the next 10 years. So there is widespread expectation that inflation will normalize over the next year. So what will it take to happen? Probably a slowdown or a recession. Interestingly, the idea of a slowdown or recession is consistent with the downturn that the stock market had in the first half. In this chart, which looks at nearly 100 years of market data, we see that stocks have typically peaked about 6 months before industrial production began to slow down. And stocks have also typically rebounded about 6 months before industrial production began to recover. So, having an economic slowdown right about now seems consistent with stocks having peaked at the end of 2021. So with stocks and bonds down year to date, do we see any bargains? Despite the recent U.S. market sell-off, valuations in the United States remain near their historical averages. And opportunities in fixed income also appear limited, as real yields remain negative for bonds and flat for high-yield bonds. However, stock valuations in emerging markets and international developed markets are below their historical averages, potentially indicating attractive investment opportunities. So, it looks like stocks might be setting up for some buying opportunities. And whether it's over the long term or just during downturns like we saw in the first half, we believe that hedge strategies can enhance the performance of a traditional 60/40 stock bond portfolio. In this chart, we compare the performance of a traditional 60/40 index blend to a similar risk-matched portfolio that includes a 20% allocation to hedge strategies. We found that from 1989 to the present, the portfolio with hedge strategies outperformed the 60/40 portfolio by 0.6% annualized, with a similar volatility of return. So, we view hedge strategies as being a great tool for both risk control and performance enhancement, and we expect to continue using these hedge strategies during this period of volatility. So now, to put all the pieces of our strategy together, I'll turn it back to Reegan Rae.
Thank you, David. When stocks and bonds were falling during the first half of the year, cash and low duration provided a great safe haven. But as markets continue to move, we think the potential benefits of cash and low duration are gradually declining relative to traditional fixed income. So we're updating our tactical views to reflect this shift, and we'll be watching for new opportunities that may arise. Similarly, we think that in the growth portion of the portfolio, it's possible that we'll begin dialing down our relative view of hedge and diversifying as other asset classes become more attractive. But as always, we caution that markets are forward-looking and that our views can rapidly change as events unfold. This is why it's important that we stay nimble, and it's one of the reasons why we often prefer active managers who can quickly identify and respond to new challenges and opportunities as they happen. Given all the volatility we've been seeing, we think it's likely that we may be finding and sharing some new investment ideas in the coming months or quarters. Your advisor will work closely with you on specific opportunities as they become available. You may have seen Arnerich Massena's research team recently in Portland Monthly magazine, featured as the Faces of Intentional Investing. If you haven't seen it, grab a copy at the newsstand or take a look online. Also, if you visit Arnerich Massena's blog or LinkedIn page, you'll see we've had the honor of showcasing some noteworthy recent industry recognition, including awards from Real Leaders, Think Advisor Luminaries, Wealth Management Industry Awards, Family Wealth Report, and the Wealth for Good Awards. We're honored to be recognized for our impact as thought leaders in the industry. Visit our blog for more details. Thank you so much for joining us today.